Good afternoon, and thank you for joining us for this week's Sector Spotlight with Ami Joseph, Technology Sector Head at Hedgeye. If you have any questions for Ami, please submit them on the QA box on the Hedgeye website, and we'll get to them after Ami's brief presentation. That said, it's all yours.
Thanks. All right, everybody, we're going to go through a few slides here. Starting, let you guys all take a look at the disclaimer for a few seconds. On slide 2, and then just going right to slide 3. If you look at tech subsector performance, which is on the left-hand side, the chart on the left-hand side, the bar chart, you can see that semis have crushed it over the last year. Software and services still up nicely. If you had been long that, you'd be happy, but not as happy as if you had been long semis over the last year. On the right-hand side, you can see these different groups indexed over in performance over the last year. You could see, in the Lehman collapse, they all pretty much went down the same amount. So you didn't protect yourself, almost didn't protect yourself one way or the other into that. Since then, you could see semis have been or were the laggard in the industry for a long time and have accelerated over the last year, as we talked about. So that's, again, we're talking about the chart on the right-hand side. These are S&P 500 tech buckets and looking at the performance in these stocks. So you can see software has been the best. Semis was the worst and is now looks like about second best, and hardware has sort of fallen behind. If you go to slide 4, you can see this is courtesy of the macro team. If you look, I pay a lot more attention to sales growth than I do for earnings growth, because sales growth will drive earnings growth. So if you look at the top part of this chart and you find your finger, most of the way down towards information technology for sales growth, you could see there were 4 pretty tough quarters starting in Q4 15. And ending in Q3 16, and there were only really 1 quarter into the good times. Q1 17 should be the peak of easiest comparison, but Q2 17 should still be pretty good. But these easy comparisons roll off as we go to towards the end of the year. So by then we'll need actual growth. Slide 5. If you look at slide 5, we just tried to parse valuation for the different sectors. Probably no surprise, software, highest valuation. I'm looking at the left-hand side table that shows software on an EV to sales basis, well above 5 for the group. Semis, not far behind. And lastly, hardware, pretty much the cheapest group. And whereas both semis and software have had a reflation from the pre-Lehman period to now, the hardware group is stuck in sideways motion. Moving to the next slide and looking at short interest and short interest ratios by subsector. Hardware is the sector with the highest percentage of short interest as a percent of the float, and software is actually the sector with the highest short interest ratio. So that's an interesting 1-2 step for looking at opportunities in tech for where you can get a short squeeze, if that's something that you're looking at. If you're looking on the right-hand side of that same slide, you can see these are the average sell-side ratings across the different subsectors, and you can see it kind of almost doesn't matter. I mean, it looks like an A- for software and semis and a B+ for services and hardware. So it doesn't really, there's not a lot of signal that can come from that, looking at that side of the slide. Going to slide 7, we have a list of the stocks that in tech that are with the highest short interest and a list of the stocks with the lowest short interest. We like looking at this as a process, as part of our technology process. It doesn't drive our process, but it's something we check on pretty regularly. There are always opportunities If it's a very heavily shorted stock and we see that there's a major fundamental improvement, that's an enormous opportunity, because you're getting whatever the value of that fundamental improvement as it reflects into earnings, and then it's compounded by the fact that everybody has to cover and get out of the way. Vice versa, the lowest short interest stocks can have opportunities in them as well if they're going from overly loved and they have some kind of negative headwind that can disrupt the fundamentals in the short term. Moving to the next slide, question for this kind of process approach: how would this have done for us in 2016? So if you had shorted the highest short interest stocks and gone long the lowest short interest stocks, and I'm excluding AMD because it's weird for one stock to really move the needle that much, so we're just excluding one stock for this. You actually would have had a good year. And similarly on short interest ratio, if you had been long the group of stocks with the lowest short interest ratio and short the stocks with the highest short interest ratio, meaning basically if you had agreed with buy side positioning in 2016 with the market positioning, you actually would have made money. However, going to the next slide, if you had, not to pick on us sell-siders, but if you had followed the traditional sell-side ratings last year, you would have gotten hosed. If you had gone long the bucket of highest rated sell-side stocks in tech and shorted the lowest rated sell-side stocks in tech, you'd have totally been run over. You would have lost 30% essentially. And if you had flipped that, if you'd been really, really smart, you would have locked that in January 1st of 2016. You would have walked away with 30% alpha. You would have taken 2 and 20 on that. Your investors would have said, wow, this guy is a genius. How do you do it? And please, whatever you do, don't tell them. Going to another fun exercise we did looking at 2016 performance. This is something I did going back a few years. I took a random group of growth stocks and a random group of what I called the death stocks, which is the big cap stocks in tech that didn't have any growth. And I compared their performance. And if you were long the growth and short the death, which makes fundamental sense, in 2015 you would have made money. If you reverse that and went long the death and short the growth in 2016, you would have made a fortune of money. So it's important to watch for this pivot, because even though we all agree that growth is better than death, there are times where the growth stocks get ahead of themselves, and in fact maybe some of them are inflated relative to what they really are, the underlying value of the equity. So you get these kind of pivots that happen from time to time. Going into 17, we pointed out earlier this year that that's actually an opportunity to reverse this year, especially since a lot of the stocks in the growth basket are basically a lot of their equities had been flat for a few years. They continued to grow even if growth had decelerated from a high level to still a high level but not as high. And they were looking increasingly like a potential acquisition list, an acquisition smorgasbord, I think was the word that we used. Lastly, for some high-level just analysis stuff, going to slide 11. This is just the value of deals and the deal count in M&A over the last few years on a quarterly basis. So you can see there have been some big ones, some big quarters, some big deals. And that also has been a driver of performance for semis and software more than hardware or services. Moving on to slide 12, just want to talk about some of the high-level catalysts for investing in tech in 2017, and then kind of like stretching out our minds and kind of looking out over the next 5 years. So in 2017, we have a new iPhone launching, iPhone 8, and that is the cause of like a lot of consternation, good and bad. So there's at least weekly emails about the timing of the iPhone 8 launch, and there's been a lot of cacophony in terms of Apple yields and Apple designs and when they're going with which design and what does it include in terms of content. But a lot of the supply chain is very, very constructive on how chunky and large the iPhone 8 orders will be to the supply chain. They're hoping, obviously, that it will sell through. Based on some of the leaked specs, I admit, there are some cool things about it. Maybe one of the coolest things is the shift to a screen that mimics the Galaxy. So just the same way that the iPhone 6 mimicked Samsung by going to a larger screen size and triggered a big replacement cycle, I think the bulls would say something like Apple is copying Samsung again, and potentially going to trigger a new upgrade cycle, because Samsung's phone, I don't know if you've ever taken pictures on your iPhone and compared it to your friends' phones who have Galaxies, but Samsung's phone, I mean, the pictures are so much better, and the quality of the images is so much brighter, and it's just beautiful. So if the Apple copies that, it's possible that they convert a few more Samsung standouts or holdouts to convert over to the iPhone, and also potentially trigger a refresh among early adopters. Another trigger we think in 17, which we mentioned a minute ago, is that we think that software M&A is going to heat up this year. That could be helped along by some of the new administration efforts to help with repatriation. I'm not a policy expert, but that's definitely something that's talked about a lot in terms of tech cash that's stranded overseas. We do see tougher PC comparisons starting in the second quarter of this year and continuing to get tougher throughout the year and into the end of the year, so that's something to watch out for. We have flagged that around Intel, but it matters to a bunch of different elements of the supply chain. Changes in data center spending, this is also something that we would watch for. In the last 6 years, you've had a growth of, I guess what I would call strategic spending within the data centers. This is mainly around server and networking. And tech tends to oscillate between these investment periods where it's strategic spending, and then at some point the CEO, CFO, and CIO turn to their IT department and say, we want efficiency out of this now. Or even before that happens, the IT team actually starts to increase efficiency just because they're coming up the learning curve on the new thing. So in the last 6 years, the new thing was cloud. You had the cloud companies spending to take over the world, and you had and convert enterprises over to their platforms. And you had enterprises still spending to keep the lights on and stay ahead of their problems and essentially keep the machine well oiled. So you had two sources of spending, and you, on top of that, at the enterprise level, you had spending that was for development, strategic purposes, to sort of figure out a roadmap to the cloud for enterprises. So you had a lot of inefficiency in spending, which is actually a really, really good time, obviously, to be a vendor in this category, because you're not getting a pure market. You're getting a market plus some level of strategic spending. At this point, roadmaps are set. Enterprises are starting to decommission legacy data centers. They have their pathways fixed. Winners and losers are forming among the public cloud service providers, and so some of them are slowing their spending, some of them are keeping it. The winners are keeping that spending high. But essentially, and you have a transition to an efficiency technology in the form of containers, which is an interesting technology coming up software containers coming up right at a time where the industry is looking for efficiencies. So that's something to be aware of as we move more heavily in the back half of this year and into next year. And lastly, the optical networking cycle seems to be alive and well and kicking, and that's something that doesn't come along every year. That's kind of once in a decade type of thing. On the right-hand side, just looking out over the next 5 years, and I'll stop after this one and we can take questions, is you've got a heavy consolidation phase in software, I think, over the next 5 years. Even among the next generation software winners, a lot of them are stranded on growthy islands that can get lost in a sea of infrastructure as a service companies coming up. So if and when Amazon launches application strategy into some of these categories, these companies, at least their multiple will get a big dent even before they see any impact on revenue or fundamentals. So I think there's going to be a fairly heavy consolidation phase in software over the next 5 years. So that'll be interesting. In semis, it's always cyclical. I'm not trying to say there isn't a cycle here. However, the 15-year cycle in semis, the broader cycle in semis, has different cadences for supply growth. And over the next few years, maybe not all the way to 5 years, but maybe 3 to 4 years, you have relatively benign supply growth technologies driving the industry, and that leads to ongoing tightness. Essentially, power continues to migrate into the hands of semiconductor companies, which that power migrates away from them when supply growth is very rapid, and they lose position, they lose multiple levels of multiple. The last time around, we had a strong supply growth period from 01 to 08. Price to book multiples came way down in semis. And the last point there I'll make is over the next 5 years, you're going to start to see cliffs forming in legacy technology companies where they're currently hanging on to a legacy stream of maintenance, but because of the decommissioning process in enterprises and the way that people are actually taking data centers offline, that means that at some point that those revenue streams start to dry up and actually fall off. And so picking your legacy horse carefully is really, really important. I'll stop there so we can take questions. Those of you who have the deck, the rest of it is just some high-level samples of some of our work from the calls we've made recently. There's a few slides in there from Sabre, a few slides which were short, a few slides in there from Intel, which we are short, and a few slides from Corning, which we are long. And we'll stop there.
All right, great. And again, if you have any questions for Ami, please submit them on the QA box on the website. So maybe just following on to your comments about the semis and the cycle, you could have made a lot of money and lost a lot of money if you were on the wrong side of those trades. The stocks are pretty volatile, especially the last 2 years. So how do you go about thinking about timing the pivots on when to be long and when to go short, just given how cyclical it is and volatile the stocks can be?
Yeah, I mean, it's always confusing in the moment. Mm-hmm. It's always hard to see the forest for the trees when you're looking through it. We had a note on this not that long ago that one of the key kind of canaries in the coal mine or signalers for past cycles hit a second derivative bump, which usually is a negative. So they basically went from raising estimates to keeping guidance flat when they presented to Wall Street. And so that would be considered, typically that would be considered a second derivative bump and would be a signal to go and get negative. But the stocks powered right through it and are higher still from there. So it's definitely in the moment can be really tricky if you're looking for the same signals as previous cycles. The main thing to focus on in terms of the forest and the way to, even if you lose a little bit of money in the short term, you make a mistake that gets you short, let's say a month, and you need to unwind that and come back and get long, that's okay. That doesn't ruin your year. The way to make sure you don't get caught on the side of a major move, like a multi-year move, is to stay focused on supply growth technologies in semis. That's the number one driver of cycles. And a minute ago I mentioned that we had a fast growth period from 2001 to 2008. That was where we were going from small size wafers to large size wafers. And each wafer to wafer transition was almost 2.5 times more supply per wafer. So you can imagine across the period during which that new technology was ramping, semis had basically almost near constant oversupply. So the stocks had lower highs and lower lows, and the group eroded. And if you had shorted all semis throughout that period of time and basically just been long Qualcomm, which was long for its own standalone reasons that had pretty much nothing to do with the cycle, you would have been a genius. You essentially would have won. You could have locked that in 2001, walked away. You'd have had some tough months during the sharp, rallies that there always are, from time to time, but across like a 10-year horizon, you would have been a big winner. We don't have that kind of rapid supply growth today. And the other main supply growth metric that has been a stalwart for 50 years, which is the regular cadence of what people typically call Moore's Law, incorrectly, but it's basically just line width modifications in geometries. It's a little too technical, sorry, but that adds supply growth. That's been stretching out. So even though we have a bunch of it in 2017 has a bunch of it. There's been a gap for a few years, and there's going to be a gap after 2017 for a number of years. And so basically, after this year, to grow supply, semis are going to have to rely on brute force manufacturing, adding supply lines, adding wafers, not adding new technologies. Obviously, every year there's some improvement in technology. The Sisyphean ball gets moved up the hill, always in technology, but the rate of supply growth from the technologies will be slower, and the rate of supply growth from manufacturing supply will come up. And so that's by definition, that's a slower period of time for supply growth. And that'll be a much better time, a good time for owning semis in general.
Okay, great. Can you touch on the, speaking of supply growth, all this is for Micron, can you touch on the supply growth curve for MU, and is this still one of your top longs? And kind of folding another question into that, what's your valuation range, or how do you think about it? Buy the dips, sell into strength?
It's a tricky name. It's a heart attack name. It's a name that attracts a lot of short interest when it goes up. People like to be contrarians. People like to call the top. And I also have those feelings that come up, and I also get dragged into that. And when I come up with great short theses on Micron, and I can articulate a short thesis on Micron probably better than one that you could hear anywhere else. When I hear that, in myself, I go and I check the data, which is the last time I was on HedgeyeTV on the macro show. I go back and I verify the data, and if the data is still pointing in the right direction, I stay with it, and the data still continues to point in the right direction. In terms of the supply growth curve, this is an important one. I'm not sure if we can put this one up on the screen, but yeah, excellent, thank you. You can see that from where we are right now in the first half of 2017, supply growth rate has definitely decelerated, but it looks like we're about to fall off a cliff in the second half of this year. Now, that is bullish from where we're standing, because anybody who wants to sell components of any kind, applications of any kind in the second half of this year, whether it's server or PlayStation boxes or networking equipment or phones or PCs, anyone doing that in the back half of this year and probably for early 18 needs to make sure they have some buffer on the inventory side, because the last thing you want to do is miss out on a sale of a $1,000 PC because you didn't have enough inventory of the $30 of DRAM sitting on your shelf, especially with the way that inventory velocity moves, and especially with the way that the buyers tend to force the sellers to hold the inventory on their books until it's time to pull. So it doesn't become a cash headwind for the buyer. But yeah, the last thing you want to do is miss out on a tech hot selling season because you didn't have enough component inventory. So step one is you got to add inventory buffer, and that's bullish for now, for today. The second step is less bullish, and that's when you start to design workarounds. And that's not easy to do on a dime, to design a lower demand envelope for your application. For example, to say, okay, my phone is going to, instead of having 2 gigabytes of DRAM, it's going to have 1.8 gigabytes of DRAM or something like that. It's hard to do that. If you want the phone to have a specific performance, if you've designed the whole phone around a certain clock frequency for your processor, if you've factored in the number of applications you want to run, the speed of the transmission of data, upload and download, I mean, you've got a lot of other complicated pieces if you're going to fix that out. At some point, though, you get around those hurdles. Maybe that's by 2018, maybe it's second half of 2018. And then the demand curve whittles down. And that's when that becomes a bearish trend. But for now, I think this is a bullish trend. So I'm sorry that that's not more definitive. And I know that there's plenty of people always worried about the stock, and I promise I keep checking on this thing all the time. As far as valuation ranges go, and yes, it's still on my best idea buy list. As far as valuation ranges go, this thing moves around, okay? You can imagine pricing flows to the bottom line. Almost 100% of price increases flow to the bottom line, and likewise, price declines flow almost 100% to the bottom line. So you're in an environment where your model may have been telling you the stock was worth $24 just 6 months ago, and now it's telling you it's worth $55. I'm not kidding. So it's important to keep perspective on that along the way. Try to value the cash flows. Try to look at cross-cycle earnings. Try to look at earnings over a stretch of period of time and use some kind of cross-cycle multiple. And based on the things I'm looking at, I'm still looking at a mid-30s to upper 30s level from where we are today.
Okay, great. There's a lot of questions in the queue, so I'm going to start merging them together, at least the relevant ones. Why has hardware underperformed, and are there any contrarian plays in that space given the valuation divide? I think you showed it on slide 5.
Yeah, so I'm just pulling up the composition of that hardware group that I showed because that would be good to be able to sort of eyeball that. Excuse me for a second while I pull that up. Here it is. Yeah, so hardware has gotten the short end of the stick from the cloud. The cloud companies who are building out their own infrastructure are building unbranded, mostly unbranded hardware-based systems. So they're buying components and they're building their own hardware, and to a large degree, they're also building their own software. So that would indicate that the software group should also have collapsed, except that there's been an explosion of innovation in software in terms of new applications, new things you can do, attacking old legacy approaches with a new either new business model or a new technology model. So there's been a really great explosion of creativity there. In the hardware space, the storage plays have gotten hurt. This is like the EMCs of the world, the NetApps of the world. The networking guys have been hurt, which is the Junipers and Ciscos of the world, and that's a chunk of this segment. And so it's very hard to get super bullish, given that they're selling into a shrinking market opportunity, and the fast growth market opportunity they're not participating in. Now, that being said, to answer the second part of the question, which is, are there any opportunities to go the other way and go against that stream, yeah, I think that's interesting when you can find those. And specifically, for example, we highlighted Citrix a few months ago, which sells, it's a software company, but it sells a NetScaler hardware box, which is an ADC box for managing the performance in your network, inside your network in enterprises. Citrix sells NetScaler boxes to Amazon Web Services at a decent rate. It's not growing as fast as Amazon is growing, but in light of the fact that one of the legitimate pushbacks for Amazon, for AWS in general, is the slower speeds of their networking and the fact that they have trouble standing up applications consistently, I don't think this is an area that Amazon's is about to short. I think it's interesting to look at kind of a legacy provider like that, like Citrix. And actually Citrix is up a lot since we put out, it was a Sunday note, and we talked about this in the fall, that Citrix's cash flows were definitely undervalued if the company wasn't going away. And we suggested it wasn't going away, and I actually regret not putting it on our best ideas long, because it's been a home run stock since then. So there are opportunities to look into this group, and I would focus on the networking group now to peel away and figure out if there's something there that has a lot more staying power and maybe a lot more complexity to it than is being given credit.
Okay, great. And you kind of touched on this on the presentation, but do you see any important products over the next 5 years? And then specifically for Amazon, how does it kind of change the tech universe going forward?
Yeah, I mean, Amazon is a beast. They are innovating at light speed. I'll give you a small example. The security software universe is a flywheel of innovation. There's constantly a new company coming out with a new algorithm that's going to protect some new area you didn't realize you had vulnerabilities, and it does well for a little while. And this universe has been wondering how they're going to perform in a cloud world. Some of them say we're going to do great in the cloud world, some of them are making the transition, but fundamentally they all built their software around the idea of a perimeter and protecting the perimeter, but in the cloud there is no perimeter. It's like that moment from The Matrix, there is no spoon. So they're all scrambling to redesign, or not all, some of them, the leaders are scrambling to redesign and get to the other side. And so they were claiming that the cloud is going to be a jump ball for them, and then in November Amazon launched a security software product for their own customers based on their own software that they built themselves, which is terrible because it just shows Amazon crushing yet another segment.
I was going to say, who do you short off that?
Well, Akamai is on our short bench.
Okay.
But the one that Amazon, Amazon's first security software product is right in the teeth of where Akamai is going. And Akamai is running as fast as they can to get away from this monster. Yeah. But Amazon is changing so much. They are really driving from the top. They are driving major changes. And if you think about it, one of the biggest sources of innovation that they're doing is they're taking the Moore's Law floor, that manufacturing floor, and they're bringing it all the way up through to the customer. Whereas before, this stuff got stuck along the way. Why? The chip guys would battle it out, have price declines every year. The hardware guys would say thank you very much. They would a little bit pad their margins, a little bit have price competition to serve the end enterprise customer, Citibanks, Enterprise IT, GE, whomever. Great. And the software guys would sell directly on top of that. And software was basically a model that you paid for innovation that already happened, or you already finished all the R&D and development and everything to do with the product we're selling you. So you're going to pay me $100 now, and you're going to pay me $25 a year to continue using that license during the maintenance period. And by the way, when I want you to migrate to my new stuff, I'm going to start raising my the license cost on you 10% a year afterwards to force you to go to the new stuff. So that was the model before. And Amazon comes. They buy the chips themselves, which again decline with Moore's Law every year. They sell you the hardware as a service, so you're not buying any hardware, and they're offering you a lot of free software on top of that hardware alongside that service. So and it's a subscription, so everything new coming out of Amazon you get every month. So the software guys who are still collecting maintenance checks on stuff they finished coding 10 years ago. Well, that doesn't happen anymore in tech. So that's a deflation for software. The hardware guys, we talked about how they're getting disrupted. And Amazon's model is to use price declines to continue to stimulate demand. So they're actually taking those price declines that come from Moore's Law and throwing it right at the customer in order to grow their addressable market and land grab more share away from traditional IT. And it's been a brilliant strategy, and they've been on this curve for a long time. So Amazon is changing everything.
We need Amazon in healthcare.
Amazon is changing I wish there was something like that in healthcare.
Yeah.
It's been so slow moving.
All right, great. Well, we do have a bunch of questions left, so maybe we'll kind of do like a rapid fire type of approach
Okay.
here.
I'll try to keep it tight. Let's do it.
You're short on Intel. How much downside does it have?
20%.
Okay.
Or more.
So when do you start shorting the SMH?
Second half of the year.
Okay.
September.
What do you think about Intel's acquisition of Mobileye?
Terrible. And we highlighted it, and we don't usually get these opportunities, but we highlighted it in advance. Before the deal ever happened, after the Analyst Day, we said if they're really going to do this, they're going to buy Mobileye, which is a terrible idea, is what we wrote at the time. And then they announced, the morning they announced it, we wrote, I can't believe they're doing this. I can't believe they're making this mistake. It's a disaster.
Okay. What are the fundamental characteristics of the death group?
Large companies with very, very strong legacy technology positions who are very cheap on free cash flow, or were cheap on free cash flow a year ago. Their stocks have since moved a lot, and they have an opportunity now in a window that's going to close to change themselves and make themselves ready for the future. They got to buy somebody, they got to change what they sell, they got to fix it, whatever it is. They're usually pretty cheap. They're heavily shorted. They have a lot of cash, so they've got opportunity. Some of them have opportunity, not all of them. But they need to make that change now because growth is coming back, and the death guys, this is their last chance.
Okay, last question. What are your current thoughts on IBM, especially as it relates to infrastructure as a service and the cloud in general?
IBM is screwed on almost every level. However, and one of the worst things is to look at the last 6 years of M&A for IBM, because they've bought some incredible technology companies, really, really incredible technologies that have all disappeared into some black hole. There's no revenue growth from any of those companies that they've bought. Revenues are down every year at IBM. Where is all the stuff they're buying? I mean, you might as well just throw out that entire M&A. That's just the biggest damnation for them. However, as a stock, keep in mind, 6 days to cover. 6 days to cover on I think it's 165 billion or 180 billion market cap stock. 6 days to cover the short. That is outstandingly large, which means even a small positive goes a long way. And the small positive might be that their cloud software is okay. And that's the latest that we're hearing. We put a note on that this past weekend, that IBM's cloud software might actually be okay. And that's the weird thing in this situation is you might look at the pile of IBM and say 90% of it is terrible, but if you have this one little sliver of goodness and 6 days to cover, that means you really can't short the stock.
Okay. All right. Well, thank you very much, Ami, and thanks everyone for joining us for this week's Sector Spotlight. Catch you back next time.
Thanks, everybody.